Thank you. Hello, David. I'd just like to hitchhike off Alex's question a bit. I'm not really greatly concerned about a gold or silver position. It's really a long-term insurance policy, and it's easy to avoid or just ignore price fluctuations from time to time. My concern really goes to the securities inside the wealth management portfolio that I have, and I'd just like you to amplify some explanation you had earlier about whether the companies can sustain their positions and stay alive while we wait out, all of these adjustments. It seems to me that fear is a major factor as I just look back over my investment life as it pertains to gold and silver prices. When you have a sense in your gut that the population is fearful, price seems to go up. And whether it's through the administration or politics or people just getting tired of being fearful, and the mood changes, it takes quite some time before that mood goes back. And I just have a sense of there being a change right now in everybody I speak with, and it is in great result, or great part, the result of the dumbed down population we've spoken of today. But people have just gotten tired of being on the sidelines and being afraid, and I see it in all walks, in all the conversations I have with people, irrespective of their circumstances. There's just not the fear that I saw in 2008 or 2009, even in 2010. So I'm wondering how long this is going to last and whether the securities inside the wealth management portfolio can make it through this tough period.
Okay. Yeah, great question, Charles. One, just to start out with, the mood change is a very significant thing, and not to question the sample size, but the statistics that I've been reading would indicate that net worth of over $500,000, there's been a significant mood improvement. And that's in part because you've got an asset base tied to your two primary asset classes which have improved, which would be the equities market and the real estate market. With that improvement comes buoyed sentiment, comes the natural wealth effect of why should we worry? The balance sheet has improved. There's no reason to worry. It's not the socioeconomic strata, sort of 500,000 in net worth and above, that I would consider the primary driver in our markets, and ultimately the primary driver of our economy. The vast majority of Americans are still dealing with either a house price that's upside down. We're dealing with 25% of folks that own homes today that are still underwater from original purchase, and another 18% on top of that, which have so little equity as to make it non-economically feasible for them to sell and move on to something else. So they're not yet in that group who could say, I've seen enough of a recovery in real estate to really have a meaningful impact to my sentiment, to make me feel better, to make me go out and spend, et cetera, et cetera. So that's a part of the issue in play, is the mood change is with an asset-owning group, I would suggest, more than sort of a debt-dependent, living paycheck to paycheck segment of society. There, the mood is still very sour. And unfortunately, the vast majority of Americans do live paycheck to paycheck. And so, consumer sentiment, that's a part of the issue. We've seen an improvement off the lows, but it's nowhere where it was in 2005, 6, and 7. If you look at a chart of consumer sentiment over the last 6 months, it looks like it's on a tear to the upside. And then when you step back and look at it from a 7 or 8 year perspective, you realize we've only recovered about 10% off the lows compared to where we were in terms of consumer sentiment in 2005 and 6. So it's improving. That's what the mass media gloms onto is, yes, it's improving off of those very, very low levels. But again, relative to where it was, it's near record lows. It's still near record lows. A couple of other things in terms of the time frames till recovery. We are surprised by a time frame of about 90 days that the market in gold and silver is not already turned. Classically, your corrections in gold and silver on the short end are 12 months long, on the long end are 18 to 19 months long. Now we're into the 22nd month. So, our surprise is that we're 90 days late. But on the other hand, if you look at the draconian measures put in place by the Fed and the Treasury to prop up a sense of recovery, which frankly, and we could look at this in detail in a couple of different categories, I don't think it's there. I don't think the evidence supports that we are in recovery. Nevertheless, you have that sense that we are in recovery. And it's with that in mind, we shouldn't be surprised that it's taken an extra 90 days. Let me give an example from the S&P 500, because the last 4 years in a row, we've had a swoon in the marketplace, the general equities market, the S&P 500, every summer. So that classic adage of sell in May and go away, yep, for 2012 it made sense, 2011 it made sense, 2010, 2009, and lo and behold, come August or September, guess what you had? You had the Jackson Hole meeting, and you had a promise of more quantitative easing from the Fed every instance in the last 4 years. The Fed has increased its commitments at Jackson Hole. The Fed's not increasing its commitments this Jackson Hole. This is very complex in one stance, but what did Obama just do this week? He just turned he just turned Ben Bernanke into a lame duck Fed president. He can't do anything now that he knows that he's basically fired. He's not coming back on board, and he was completely disrespected by the president this last week. With that in mind, you're not going to see much of a change as the baton is being passed from him to someone else. On top of that, he's already said he's not showing up to Jackson Hole, and if anything, they're talking about reducing commitments, not increasing commitments. That has been the necessary ingredient in buoying equity prices at the end of every summer market decline in the S&P 500. So don't count on QE, and lo and behold, what we've really had is 1 month extra time before we see the decline. I think what we just had initiated this week in terms of a decline in equity values, it's here to stay. It's here to stay. I don't know if this is the big one. As in taking us down 30, 40%, but for us to see a 10, 15, even 20% correction would be no surprise whatsoever. And the question is, with the Fed hamstrung, can they do anything at all to save the equity markets, again, with the transition at the Fed and with the awkwardness of a no-show at the Jackson Hole meeting? How does this have any bearing on our positions? One of the things that has mitigated interest in the precious metals over the last 18 months to 2 years, outside of those summer swoons, has been an increase in the value of equities. Why do you need gold and silver when equities are moving higher? This is sort of the classic reason why people own gold in the first place. If you're in a zero interest rate environment, which we are, then your fixed income portfolio is going to suffer for it. Fixed income portfolios barely eking out a positive rate of return, that environment is positive for gold. But here's the caveat. If equities, on the other hand, are doing well, then you do have one place to go for positive growth outside of the gold space, even if you are in a negative real rate of return environment. And then here we have what we have in terms of current circumstances. I think your one option outside of the precious metals in terms of a place to be, it's just gone away. The general public has enjoyed, or whoever has participated in the move higher in the major stock market indices, they don't have growth ahead of them. They frankly have downside ahead of them. This, too, increases the appeal of gold. People looking for a port in the storm, people looking for a safe haven, people looking for something other than cash that is still liquid. and not the bond market. And that's I think one of the other compelling things about this issue of the Treasury market yields rising this week. Ordinarily, remember what you normally see when equities sell off. You normally see a rotation from equities into bonds. Had you seen a rotation from equities into bonds, you would not have seen yield spike, and in fact they did spike. You didn't get your normal rotation into bonds. People are suspect. People are very suspect of the bond market, the U.S. bond market. You had people move straight to cash and not into bonds, not into short-term treasuries. So in terms of time frames, I think we're talking about 90 to 120 days before we start seeing positive traction. I would argue in the next 30 days we could revisit, not even revisit, we could set new lows, $1,250 to $1,200 on the gold price. I think silver's pretty stable between $19 and $20. Looking back again at the charts, it took a number of years to get above 20, and that represented the launching point for the move to $49 an ounce. So it does represent a very strong level of support for the silver market. Arguably, we've wrung ourselves out on the downside in silver and may have a little bit more on the downside in gold. But to go out on a limb, it's not unreasonable to see gold trade well above where it broke down at $1,530 earlier in the year by year-end, maybe even $1,600 by year-end. So, Charles, I'm not concerned at all about the companies being able to survive a 3 or 6 or 9 month period. Anything that we would be interested in would have survivability of 3 or 4 years, given cash positions, given low cost of production, given total resource bases and things like that. So we don't have to wait 3 to 4 years. We may not even have to wait 3 or 4 months. Hopefully that's helpful.
Well, that is, and I appreciate it. I guess I would tell you that my securities portfolio has gone down about 10% in the last week, and I'm considering selling, but if you feel that the securities are long-term plays, then I'll hang in, and that's really what I'm looking for, is some sense of that in order to make a decision.
What I have done personally is, and this includes this week, not only the physical silver position, but on our own wealth management platform, I've added 2 positions at these numbers. If I liked something 20% higher and it's today trading at 20 or 30 or 40% lower, guess what? If the reasons for owning it still exist, don't look a gift horse in the mouth. That's something to be bought. And I wouldn't be liquidating. I would be adding to positions here, again, with the understanding that the fundamentals are still very, very supportive. So, lower prices, just as attractive as silver bars are to me this morning, I would say there's a number of shares that those positions should be added to, and this, I think, will end up being one of those periods. Keep in mind that the lows that we put in 2008, we saw a move higher in those kinds of companies of between 5 and 10-fold off the lows, 5 and 10-fold. And it's not going to surprise me to see those kinds of moves again off of the lows. Do we have the lows now? Will we have them in the next 30 to 60 days? I think we'll have them in the next 30 to 60 days if they haven't already been put in.
Much appreciated.
You bet.
Hi, David. How are you?
I'm doing great, Eric.
Good. I got a question regarding comments made by Bert Doman here in his Wellington letter. I just want to use a couple of sentences that he wrote. He basically said, the Fed comments were interpreted as being willing to lower quantitative easing. And Bert goes on to say, he says, we strongly disagree with that interpretation. As you mentioned before, with this injection of funds at $55 billion, still wasn't enough to stop the movement. Do you agree with that assessment from Bert that is he going to continue, in your estimation, to push QE hard? Bert goes on to finish his assessment there, and he says there's no way Bernanke is going to risk his stimulus program of the past 5 years being ended prematurely. His goal is to retire from his job early next year in glory. And I'm wondering, do you get the impression that he is willing to just keep throwing more money at this issue until he can retire, so he can walk away from his position, so to speak, a hero, having controlled this or averted this so-called near catastrophe in the financial markets?
Great question, Eric. $4 trillion is the next destination for the Fed balance sheet. It could go as high as 5. That'll take a couple years to get to. I think that the Fed will continue to monetize. They may come up with another euphemism. I mean, let's say we end quantitative easing, but I mean, you tell me. At this point, we could become Scrabble experts and probably come up and take a bet on what the next thing is going to be called that represents money printing and monetization. A rose is a rose is a rose. I don't care what they call it. I'm going to still look at the Fed balance sheet and see what the activity is at the end of the day, regardless of how they title it. So yes, I agree with Bert that we will see a continuation of credit expansion, money creation, monetization of debt, and that I think is a certainty. There are some issues that I would have with Bellman's analysis on what that means specifically. The implication for him is that we should go out and buy equities because if the money printing's there, then you're going to see an improvement in equity values. And, we can look at specific sectors that he's recommended, and I'd be happy to do that. But just in general, there's the issue of earnings have continued to deteriorate for several quarters now. And there is the problem, even with money printing and an improvement in price in the equity values, companies are not making the money that they used to be. So, they meet earnings expectations, but revenues disappoint. How many times did we hear that this last quarter? How many times did we hear that the quarter before? Well, I care what a company is making in terms of money. I know what it means to run a business, and when sales are off, it doesn't matter how I manufacture, create, or otherwise creatively concoct an earnings number. It still matters that sales are down and revenues are off. And that's what we've continued to see quarter in and quarter out for probably the last 3 quarters. And, here's the problem. We have a lot of creative financial engineering. These firms are not stupid. They don't want to lose traction. They'd like to impress the public and will only give significantly lower guidance if they have to, if they must. And we're seeing companies buy back their shares with their treasury, and that is a large portion of the improvement that we've seen in earnings per share. Specifically, that's the statistics from I think it was the Royal Bank of Canada. I could be wrong. It might have been RBS instead, Royal Bank of Scotland. But they put together an estimate of 40% of the last year's earnings improvements being attributable to stock buybacks, share buybacks. So this is I'm probably going beyond your question, but yes, Bert I would agree with Bert, they will continue to print, but I don't think it's going to have positive ramifications for the equity market because the best that they've been able to do in the last couple of quarters is try to fabricate a better earnings number, and I think the market's wising up to that. I think the market is wising up to that. I certainly get that sense when I talk to Trish Regan on Bloomberg or some of the other folks that I interview with. What they will basically say is, yeah, I hear you. I understand there is a disconnect between economic activity and the stock market. But my point is, you can't do this forever. You can't have stock prices continuing to move higher and higher and higher without a reality backing it. Ultimately, reality does matter. Ultimately, earnings do matter. Not what you fabricate, but on the basis of real revenues and real sales. And so that's the deterioration that we're seeing. You can't cover over that with money printing. You can make an asset price go up with cheap credit. And that's what we've had. That's what we've had. Margin numbers on the New York Stock Exchange have hit new peaks, $384 billion. We're waiting. We've got a couple days more before we have the May numbers, May margin numbers. But my guess is that the May margin numbers, these are folks borrowing money to buy even more shares in the Dow and the S&P and what have you, will be at the very peak in May. And my guess is by the time June numbers come out, it will already be in contraction, and it will represent, May will represent, both in terms of margin exposure and equity momentum, the tipping point moving into the next recession and the next cyclical bear market in stocks. So I read Doman. I like Doman. He's a wonderful guy, a great friend of the family, and we have many points of intellectual compatibility. But certainly some differences also in terms of tactical application. And I wouldn't, for instance, I wouldn't touch housing. He's very bullish on housing. You look at a Sherwin-Williams share price, and to buy Sherwin-Williams today, you'd have to be playing the greater fool theory, paying a high price, the highest ever, hoping that someone else comes and pays you an even higher price down the line. There's no value in the housing market today, in the housing shares, in the home builders. These are places that I would consider. Again, I'm not a day trader, so I'm not saying that there's not money to be made in the short run on any of his recommendations. But as an investor, you're looking to lose money stepping into the equity markets and certainly stepping into the housing sector. So, yes, I agree with him, and there's other areas where I would strongly disagree.
Okay, and could you comment on your estimation? Where do you see interest rates going? There's probably not but a handful of all your clients who don't have some kind of a loan somewhere, whether it's a mortgage or some other type of loan. Do you think that the Fed has lost control at this point? And if interest rates are going to go up over the next year, what do you see them rising to and how fast?
Well, the interest rate market is a little bit like a giant steamship, and when you decide to turn, it's not as if you can turn on a dime. What we've seen in the last week is behavior that would be sort of turning on a dime behavior. So I don't know that even though we've had a violent move higher, not just the last week, but the last 6 or 8 weeks, I don't know that this is the end of the move in interest rates lower. You could have a market manipulation. If we had a market meltdown, the S&P shedding 500 points, the Dow shedding 3,000, 4,000, 5,000 points, you would still find that rotation into Treasuries, and you might see the 10-year back below 1.5%. I would agree with Bill Gross, and I'd lean probably more heavily on his expertise in the fixed income space. The bull market in fixed income is over. How long it takes to materialize with significantly higher rates, it could be next month or it could be 18 months from now. But the fact is we have turned a corner. Again, when an interest rate cycle ends, there's usually an 18 to 24 month transition period. There's volatility in it. And ultimately, in retrospect, you can see a trend reversal, but it takes a good 18 to 24 months to turn the market. Why? Because you're talking about a trend that has been in place for decades. The average interest rate trend, just looking at U.S. debt here in the United States, is about 28 years. We've already overstayed our welcome. Rates have been coming down since the early 80s, well past that 28-year average in terms of our interest rate cycle. For it to take a couple years to turn, that's very possible. I don't like what I see right now. I don't like the fact that the Fed can't buy rates down. And that is, I mean, I might be even talking out of both sides of my mouth here, but the behavior this week is the scariest I've seen in the Treasury market in my entire career. You don't, I mean, the Fed has everything at stake, just like the Bank of Japan has everything at stake. And we already know at the end of the last several weeks and months that the Bank of Japan has lost control. The JGB market, the Japanese government bond market, they said they were going to step in and keep rates stable, and lo and behold, their Treasury market yields skyrocketed as people looked at it and said, we smell a rat and we're going to dump all the JGBs we can, the Japanese government bonds we can. I think you're beginning to see the same thing in terms of the behavior in the Treasury market. Investors are smelling a rat. Institutions are smelling a rat. Institutions are realizing that the Fed has a tremendous amount of control, and you should not bet against the Fed unless they're losing control, and it appears that they may be. So a normal turn in interest rates should take years. I think Gross is right. We have made the turn. Do you see that evidenced next week or over the next 6, 8, 12 months? I don't know, but I would not want to. I wouldn't want to be long fixed income right now. I want to be reducing my exposures to anything that's interest rate sensitive, which would include high-paying dividend stocks, utilities, et cetera, which have been the go-tos in this interest-starved environment. Understand, money in is also money out. This is what we talked about this last week in the weekly commentary. Hot money flows. You're going to see those characteristics and the volatility that you would associate with them in areas that you would normally consider low volatility. And then again, that's going to have a lot to do with this interest rate trend.
Great answer. Thank you very much.
Good evening, David.
Hello, Howard.
Got a couple of questions, but first of all, a comment. If my memory serves, going back to Marion's question, your father got me out of gold at about 700 in the late 70s. So yes, your family has at various times, at least I know at that time, we're recommending that maybe we run our course here for at least that portion of the bull market.
Well, Howard, I apologize that we were a day early, but unfortunately, in that kind of a market, you just don't want to be a day late.
Exactly. The reason I think for this conference call, at least in part, is the volatility this week. And I have not seen any comments nor heard any this evening with regard to, and this is my first question, what took place that caused the overnight drop and a little bit of support of that this particular week in gold?
Sure. Well, what took place was the Fed saying virtually nothing, but his comments being interpreted as saying something very clearly. And it was interesting, even today, one of the other Fed presidents, I believe it was Lockhart, who came out and said, listen, we shouldn't have laid out a roadmap if we don't have the economic numbers to support the recovery, which is to say everything that the Fed said was predicated. It was predicated on a set of variables that aren't in play today, but if they are in play tomorrow, then we will execute this kind of a plan. So the market's gotten ahead of itself. The market has gotten ahead of itself, assuming that the Fed has committed to, in some form or fashion, taking away this $85 billion worth of asset purchases, and that being somehow constricting or constrictive in terms of monetary policy. Does it represent tightening or doesn't it? The market is judging his comments as representing tightening. Again, the first thing I would say is whether he says it and does it are two different things. And he's put himself in a corner. This is your classic liquidity trap. The economy is only humming the way it is because we've had a massive amount of deficit spending, and that deficit spending has been financed by the Fed. The Fed
I thought the drop was prior to that announcement. Did I miss something?
No, it was not prior to the announcement. Gold was holding fairly steady up until the announcement, and actually it was steady through the announcement. It started to fall to pieces in the context of his question and answer session.
Okay. Second question. Goldman Sachs, after the Friday, Monday black gold days, a few weeks ago, came out within a week and said that predicted that gold would be at about $1,450 for the next year, or at least through the spring of 2014. And I wanted to get your reaction to that with a part B of my question. basically being, I know you look at technicals, and I'm just wondering, with manipulation that has taken place, severe manipulation, how much the technicals on the short term, basically being the next 12 months, let's say, how much one can rely on them in a market that's being manipulated as much as it's being manipulated on a worldwide basis.
Well, there is a degree of manipulation. There is also the insanity of response to that manipulation. It doesn't take much from the administration, from the Fed, from a Goldman Sachs, from whatever the bank is that's issuing whatever comments they are about whatever asset class in question. The question is, what's the response to it? And that can be equally insane. We're in an environment where no one is operating on a clear set of principles. I mean, there are things that keep me up at night that maybe shouldn't, and one of them is the fact that the stock market has become a ghost town. 70 to 80% of trading today is high-frequency trading, trading on the basis of computer algorithms. Computer algorithms are basically if-then scenarios. There's a lot of assumptions that go into ifs and thens, a lot of assumptions. And, when you're in an environment that is completely insane to begin with and not operating on the basis of anything rational, how do you have an if-then scenario that continues to work in your favor? Now, this is we are perfectly set up for the same kind of crash that we saw in 1987. I say that because today, again, high frequency trading models. Today they may be buying long. Tomorrow they can be selling short, and be trying to make money on the downside. It doesn't matter to them. The probability, the possibility for a mistake, for a misinterpretation of information that's coming from the Fed, coming from a bank, it's very big. It's very big. And so you're right, Howard, in pointing out that technicals can, in the short run, be trumped. They absolutely can be trumped. 1530 could have, would have, should have held, and it didn't. 1530 had held for the better part of 18 months and failed in April. That was the point at which, as you mentioned, Goldman and a number of other companies were suggesting that it was time to get short the gold market. Again, they attacked at a critical point. Technical levels didn't hold, didn't matter. This last week, the level around 1340 should have held. It didn't. So you're right. Technicals are a helpful guideline, but they certainly are not a guarantee or a predictor of the future price. That's why I'd say on the gold price, 1,300, 1,250, 1,200, I'd be a buyer. Are there possibilities of seeing 1,100? Are there possibilities of seeing 1,000? I don't know. I mean, again, you're looking at record accommodation from the world central banks. We've put an extra $9 trillion. This is just balance sheet expansion, not the amount of money that's been created, the debt that's been created in the last 5 years, but just central bank balance sheet expansion is about $9 trillion. This, according to normal rules, is inflationary, ultimately inflationary. I don't see us getting to 1,000. I think the reason why we've gotten as low as we have is misperception in the marketplace, misperception of Fed comments, misperception, and frankly, a lack of appreciation for how weak the economy actually is. Looking at headline numbers, looking at even headlines, not just the numbers that are created, but just the way headlines are constructed today. You can read headlines off of a Bloomberg monitor, and literally in a 5-minute period, you can have two different people from the same news organization say the exact opposite things about the same news tidbit. And then computer models grab that and trade on the basis of it. That's insane. That's insane. It's an environment that, again, argues for an 87 collapse. Argues for an 87 collapse where we could see a 10, 15, 20% down day in equities. Will it happen? All we're doing is increasing probability. I spent enough time in the backcountry here in Colorado skiing to appreciate the fact that the more it snows, the better it gets in terms of skiing. It's also more dangerous.
Understand.
And that's the nature of the game. It's going to get better and better until it gets a lot worse. in terms of the money printing game, and it's going to appear like it's the game of geniuses.
Well, I just wondered with their amount of influence, the Goldman Sachses of this world making a fairly bold prediction of a specific amount in gold seemed a bit odd to me, and they usually have reasons.
Well, I think what's important, Howard, also is to look back at their previous suggestions in terms of the gold price, and you could include Citi Research in this, you could include UBS in this, you could include Credit Suisse in this. They have all trailed the gold price, assuming that it would go nowhere for the context of the last 12 years. That's not to say that privately they may not have been buying, but in terms of their public pronouncements, if gold was 400, they assumed it was going to 300, even though it went to 500. Then at 500, on its way to 700, they would assume that it's going to 400. They've always had sort of low side estimates, in part because when you look at a high side projection for the price of gold, this is a tell. It's a tell for what you really think about the world economy, for what you really think about economic growth, about you really think about currency stability. If I came out and said, as I have, I see gold going to 3,500 and higher, it's commentary on the U.S. dollar, it's commentary on the stability of the U.S. Treasury market, it's commentary on the downside volatility of U.S. equities, as much as it is commentary on an increase in the price of gold. And so the last thing that Wall Street can afford to do is give a price projection for the price of gold which in any way indicates that their core business is going to be jeopardized. These are folks that make money by selling stocks and bonds and by putting together merger and acquisition deals. They need people to have confidence in tomorrow. And the last thing that a high price of gold projected in any research paper that they have does is communicate that confidence. And the flip side is also true. If I tag the price of gold at $770, which Citi Research did about 30 days ago, it communicates to everyone in their deal book that they're trying to do mergers and acquisitions for, that they're very confident that we're on an upswing, confident that employment is going to increase, confident that GDP growth is not going to be 2.2%, but maybe 4.2%. That's what they're really advertising, is to their core business, their core revenues, what they think in terms of the economic environment we're in. Doesn't surprise me at all. It would not surprise me at all if Goldman at 1,300, at 1,200, at whatever the low price for gold is not buying with both fists. They're not going to tell you that, any more than George Soros is telling you when he's buying gold, the only thing that he seems to make public is his liquidations. And this is the point. There is an agenda. There's always an agenda. And, to look at that announcement and say, well, that must be where they think it's going to be, and that must be where it's going to stay. No, I think there's a bigger picture, and it probably is their deal book in play in terms of mergers and acquisitions, and just relative statement of where things are at and where they're going.
Yeah, and only ask the questions with regard to the short term, because I do believe that the technicals will prevail. But thank you very much, David.
We'll be talking at 2,500, 3,500, and 4,500, and the easing out of your gold position at higher numbers. We'll try to get as close to the all-time high as we set it, when we set it, as we move towards 2018.
Appreciate
Thanks, Howard.
that support. Bye-bye.